Happy morning, people. Hope you're all doing good. So today's session will be starting with the RTP of January 2025 relating to our financial management. So overall, if I'll have to say, there are about three maybe questions which are kind of newly created. The rest everything is more or less the straightforward. So in this particular session, we'll be reviewing the new questions, or if there is any new adjustments, we shall be paying attention to that. If it is repetitive, I'll just mark it as repetitive and we'll move forward. Okay. Yes, the intention is to cover the session as quickly as possible, because I know that many of you will watch this video on the examination day most probably. All right. So you wouldn't want to waste the time. So as less time, let's try to review it. Okay. So first, they have given the case-based question. So let's review that. So this is a new question. So if it is repetitive, I've called it here as repetitive. Okay, which I'll show you as well. Okay, if it's a new one, I'll cover it. Okay, so without wasting time, so let's get started with reading the case part of it. Samvar Limited, a leading FMCG company. So the moment you see FMCG is your fast-moving consumer goods. They are like your Big Basket, Reliance Fresh, etc., etc. Now, the thing that should click to your mind is, these people, do they operate on a credit sale basis or cash sale basis? Cash sale basis. Keep that in mind. And as I told you, before you read blindly the case study, always go through the requirement, because they'll give you a lot of information which may not be useful for our case study. First, they asked optimum cash balance. Okay, we'll see. We have not heard about this optimum cash balance. We'll see. Gross and net working capital. So this is your working capital estimate wala problem. Total funds needed to set up a store. Okay. Overall cost of capital. Overall cost of capital is your KO. So they've combined working capital management and cost of capital wala topic. And then they also asked some revenue subsidy granted by the central government. Maybe there's some government subsidy we are getting that they are targeting. We'll see. So we basically have an idea now what this question is about. With that in mind, let's review the case. So the Samvar Limited is an FMCG company having presence in 150 blah 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 blah. Boringo. Irrelevant data. Okay, the funda is they want to open up now how many stores? 15 new stores. They already have some stores operating. Now they want to open some new stores. Okay, the CFO and his team estimate that the funds needed for massive expansion plan would be 200 lakh per store. To set up one store, we need 200 lakh rupees, as in 2 crore rupees. Such funds would be utilized for buying out a space and setting up a store. Great. Buying the other required fixed assets, etc., etc. Excuse me. So basically, from this data, we got to know that this is a new store. What is the importance of this? The moment we see it's a new company or a new project, will this new project have any opening stock? No, will not have any opening stock of finished goods, raw material, or for that matter, work in progress. Moreover, this is an FMCG company. What does FMCG company do? They buy the goods and they sell the goods. Do they manufacture the goods? Generally, no. That means here there is no opening stock of which specifically? Finished goods. Okay, other anyway raw material WIP are anyway not there. So central government will give you a revenue subsidy of 15% of gross profit if the overall cost of capital does not exceed 10%. So if KO does not exceed 10%, then the government is telling 15% of your gross profit. How much ever is the gross profit made by the company, 15% of that government will give us subsidy. That's what government has promised us. Fair enough. Apart from the above, CFO and his team require an estimate on the additional capital needed. We'll see. Now we'll come to the main mudda. Average sales would be of one store would be 120 lakh per annum. GP margin is 18%. Sir, if GP margin is 18%, then sales minus GP is your COGS. Can I say COGS is 82% of sale? Basically, sales is 100%. If GP is 18% of sales, means obviously the COGS will be 100 minus 18%, which is 82%. That's what I've called out over here. Great. Customers pay through different digital modes and channels, including POS system, as in debit and credit card. Okay, which generally takes about 9 days approximately for the funds to get credited into bank account. Stop there. So we have various means through which customer can make the payment. Maybe some customers pay through cash. Some customers may make payment through UPI. All that is immediate. But some customers will also make payment through debit card and credit card. If any customer makes the payment through debit and credit card, will this store get the payment immediately or they have to wait for 9 days? That means this becomes what? This becomes your credit sales. Indirectly, credit period given to customer is 9 days. days. Comfortable, huh? So though means we do still, though we are an FMCG, still we do have some credit sales for the extent of 9 days. Keep that in mind. 15% of the customers use debit and credit cards. So 85% of the sales happens on a cash basis. 15% of the customers only pay by debit and credit cards. So I think we got this. Installing a POS system. Obviously, sir, for debit and credit card system, we need that machine. No. To install that particular machinery, it will come with a fees of how much? 2% of total sales through POS. That means this is your selling expenditure. In order to make the customer make the payment through this card machine, we have to install that card machine. That will take how much? 2% of the sales. That is your basically selling expenditure. We'll keep that in mind. Being an FMCG outlet, inventories of multiple products needs to be kept. Different products have different storage period. However, primarily the products are classified into 3 broad categories: durable, semi-durable and perishable. We have multiple products, but broadly if you have to categorize the inventory, there are 3 types: durable, semi-durable, perishable. Durable means it will last for a long time. Semi-durable means somewhere midway. Perishable means probably your vegetables or fruits or etc. etc. Perishable products comprise of 60% of sales. Okay, great. Of the total sale value, okay, 60% of the goods will be stored relating to what's perishable. Semi-durable constitutes 25%. That means the balance is durable. What is that balance? In 100% mein 60% is perishable. Semi-durable is 25, means durable will be the balance 15%. Okay. Inventory storage period for perishable, semi-durable and durable products are 10 days, 30 days and 60 days. Respectively. Supplier of these products gives a credit period of 30 days. So all this information, basically this information will be helpful for us to calculate the closing stock of finished goods. There are 3 types of finished goods we are dealing with here: durable, perishable and semi-durable. So this holding period they have given. You know, there sometimes we have done working capital estimate per our problem. Sometimes they give the closing stock in units. Sometimes they give it in holding period. If they give holding period, we'll use that as a base and find out. If they give units, we'll use units. Here they've given the holding period. This information are helpful for us to find out the inventory. Similarly, creditors also give us a credit period of 30 days. Each store will employ 20 personnel of different hierarchy, and a monthly average salary to staff for each store is estimated to be more or less 4 lakh rupees. Every people put together, the staff salary comes to 4 lakh rupees per month. Company will pay employees dues on the first of the next month. So this month ka salary, is it paid this month only or next month? Next month, the first of the next month. That means, can I say 1 month the salary is outstanding? Meaning March month ka salary, will the year will end on March? Will the company pay in March only or April? April. That means it comes in the next year. So indirectly they're telling we have an outstanding wages or salary to the extent of how many months? 1 month. Samvar Limited, a company, plans to give optimum cash balance as suggested by Baumol model. Till now, Baumol model was not even asked. Now they brought it into case study. If you remember working capital estimates wala problem, in majority of working capital estimate wala problem, cash balance they only used to give. Now they are saying find out the cash balance using Baumol model. You know, remember Baumol model? Square root of 2 UPS, U for annual disbursement, P for transaction cost, S for opportunity cost. We have to apply that model and get the cash balance over here. Excess cash balance, if any, will be invested, okay, and it will generate how much percent return? 12%. The disbursement for the year is estimated to be 1.5 lakh rupees per month. This is monthly disbursement. We need a annual disbursement with a transaction cost of 20 per transfer. Great. The optimal capital structure of debt equity is 2:1. So what is this? Debt and equity ka weight. The debt constitutes 2/3, meaning 66.67%, and equity constitutes 1/3, as in 33.33% has been proven ideal for raising the finance. That means, sir, they asked you to find out KO. For KO, we need weight of debt and we need weight of equity. That is given over here in form of 2:1. Okay. Alright, the company wishes to follow the same pattern for additional funds required for each store. So they are saying ideal ratio is 2:1, and the company wants to disturb this ideal ratio or no disturbance? No disturbance. Trade credit can also be used as a finance. That's okay. Now project cost up to 80 lakh. 1 second, hang on. So what is our project cost? How much money we need for each store? 200 lakhs. Hang on. Be careful. This is not just 200 lakh. There is one more hidden adjustment. Can someone tell me what is that? At year 0, there are 2 outflows. Can someone tell me what is that? One is your investment. Another one is working capital. Yes, no. So initially at year 0, we need to invest in some fixed asset and store also, and we also need some money for working capital. And here we have to find out working capital. Yes. So it's not 200 lakh. It may be more. We'll see. First one thing, we need to find out the working capital. So of that, whatever amount you require, on first 80 lakhs, cost of debt is 10%. Minimum rate expected by equity shareholders, as in cost of equity, is 12.5%. Up to 80 lakh. Then above 80 lakh, up to 150 lakh, debt ka expectations will be 11.5. Equity holders, cost of equity will become 13.5. Above 150 lakhs and up to 250 lakh, the debt ka expectations will become 12% and equity ka expectations will become 14%. Above 250 lakh, you can raise the debt by giving an interest of 13.5% and equity ka expectation is 15%. Can someone tell me what is this table? We have done one question on this. You ringing a bell? In capital structure wala problem. When you have different source of finance, what we have to do, sir? You remember one question we had done like this. We have equity ka weightage, equity ka debt. Let's suppose we need a funding of 200 lakh. Suppose we need a funding of 200 lakh. Entire 200 lakh, can you raise it at one rate or slab basis? Slab basis. So you will have to, of this 200 lakh, on first 80 lakh, there is some KO, okay? And then up to 150 lakh, meaning on additional 70 lakh, there is another KO. Like this, we need to keep working out. Okay, we had done one question on this. Geet Rath or something was that problem. I don't remember. It was in the additional question section. This was there in the cost of capital also or capital structure also. We covered this in capital structure. That has been fitted over here also. Okay, a good question if you ask me. Someone has used their kidney nicely over here. It just check. It means up to 80 lakh. They have given asterisk mark somewhere over here. Okay, this asterisk mark they're explaining. It means up to 80 lakh. The project cost company can raise a debt at 10%. Meaning if they need 80 lakh funding, the company can raise it by giving how much? 10%. Sir, for calculating KO, we need a cost of data, we need interest rate. Tell me. If you remember the format of KO, first we take source of finance, then weight, then after tax cost of capital. So this is not after tax cost of capital. What is this 10%? This is your actual interest rate you are paying to the debenture holder. So how can you tell? It means up to 18 lakh, the project cost company can raise a debt at 10%. Raising the debt at 10% means what? On their debt, company is giving an interest rate of how much? 10%. We want interest rate or after tax interest? After tax interest. That's the reason the rate what they have given by this sentence is what, sir? Is not after tax, it is before tax. Comfortable? How do we get after tax adjustment? We take interest rate into 1 minus tax rate. That if you do, you will get the cost of debt for our KO calculation. I hope till here everything is good. Okay. And for this after tax wala drama is there for equity shareholders or not there? Only on interest we get the tax benefit. On dividend will we get tax benefit? So that is not there. Great. Tax rate is 25%. Awesome. So you need to find out optimum cash balance. Optimum cash balance is very straightforward. See, as I told you, even in the most trickiest of trickiest question, there will be one or two questions which is very, very straightforward. Optimum cash balance as per Baumol model. So what is Baumol model ka formula? Square root of 2 EPS. U is given, P is given, S is given, multiply, you'll get the answer. Yes, no, sir. That's what I've done over here. We'll not solve this because it will take a lot of time. Our intention is to quickly review the answer. So, optimum cash balance as per Baumol model is given by square root of 2 UPS. How much is annual disbursement? They told you how much is disbursement every month they have given. 1.5 lakh. We don't need monthly disbursement. We need annual. If it is 1.5 lakh rupees per month, how do you get annually? 1.5 lakh into 12 rather, okay? 2 remains, this is your formula. What is P, sir? P here stands for what? Transaction cost. Do you know transaction cost per transfer? Yes, the transaction cost is given to be 20. So that is given. Divided by S. S is your what? Opportunity cost. Have they given opportunity cost? Yes. How much is that? 12%. So divided by 12% you do, you will get 24,495. That is the optimum cash balance to be maintained as per the Baumol model. First, pretty straightforward adjustment. Yes. Okay, which option has 24,995? D for Delhi is the right answer over here. Next, they ask gross and net working capital. Gross working capital means what, sir? The total of current assets. From current assets, if you reduce current liability, you will get the net working capital. So that means what? All the components of current assets and current liability given, or we need to estimate? We need to estimate one by one. Okay, people, since this is a store, they will not have raw material work in progress. They deal only with the finished goods. And we have one kind of finished goods or 3 types? 3 types. What are those? durable, semi-durable and perishable. Great, that's what they have given. And they said, once again, I'm reading for your reference, perishable constitute how much? 60% of sales. Semi-durable constitutes 25%. Balance means another 15%. That is for durable. Okay, but purposely they have linked it with the sales. But you should use your kidneys over here. Inventories are valued on a sale basis or cost basis? Cost basis. That's the reason they have also given GP over here. How much is GP? 18%. If 18% of sales constitutes GP, means COGS will be how much? 82%. First figure out that. Okay. So working note number 1 we'll put up to find out closing stock of finished goods. Do you know annual sales of the store? Yes. Annual sales of the store is how much, sir? 120 lakh per annum. So this is your annual sales. GP is given to be 18%. So COGS will be how much? 82%. Or you can also calculate GP is equal to 120 lakh 18%. From that 120 lakh reduce GP, you will get the COGS. That's another way to do it, your call. Fine. So how much becomes your COGS, sir? 98 lakh 40,000. And inventories are valued on using COGS basis and not on sales basis. Now since we have COGS, can we find out closing stock of finished goods? Yeah. How do we find? Sir, this particular 98.4 lakh, is it for one day or whole year? Whole year. Have they told anywhere 360 days? I think we didn't. We read the question. We did not find any 360, no? No. But actually in the solution they have taken 360. So if nothing is mentioned, even if you take 365, it is not a problem. But here just to sync up, they have taken 360. I have also taken 360. So this 98.4 lakh, is it for one day or whole year? Whole year. That means this is for how many days? 360 days. Okay, how much percentage? Entire 98.4 lakh, we have one inventory or three types? Three types. What are the three types of inventory we have, sir? Perishable, semi-durable and durable. Perishable constitutes how much? 65%. They only said. And how much does this, rather 60%. Semi-durable how much? 60 and 20. 60% is perishable. Semi-durable is 25%. That means the durable will be 15%. We are first wanting to find out the closing stock of finished goods of which goods? Perishable goods. 98.5 is the COGS for the whole year. Okay, of this 98.4, how much constitutes perishable? 60%. Calculate 98.4 ka 60% is how much? 98.4 ka 60% is 5904. That 59.04 is what? Total stock of perishable goods for the whole year. Meaning that is for how many days? 360 days. Entire 360 days ka stock will you maintain as closing stock? No. On an average, how much perishable goods ka store goods you store? Perishable goods are we maintain stock of only to the extent of 10 days. So for 10 days, how much we need to cross multiply and get it? Hope everyone understood this. Yes, no? Once again, you want me to repeat? I know it's been a while, but memory is coming back. Yes. 98.4 is a whole COGS. 98.4 ka 60% if you do, what are you going to get? Total stock of perishable. Okay, but this is for whole year, meaning it is for 360 days. How much for 10 days is what we need to find out. This will be how much? 1.64 lakhs. Done. In the same way, we'll have to find out semi-durable. What is the total COGS? 98.4 lakhs. How much constitutes semi-durable? 25%. So 98.4 ka 25% if you do. How much are you going to get that? 98.4 ka 25% if you do, you'll get 24.6. The 24.6 is the total stock of semi-durable goods for the whole year. Meaning this is for how many days? 360 days. How many days of semi-durable goods we store on an average as inventory? Somewhere they told, no? How many do we store? 30 days. So multiply by 30 you do, you'll get closing stock of semi-durable goods, which is 2.05 lakhs. Same way, durable also. 98.4 is total COGS. How much constitutes durable? 15%. 98.4 into 15% if you do, you'll get the total stock of durable goods. That is for whole year, meaning it is for 360 days. How many days of stock you maintain for durable products? 60, no, here. 60 days. Yes, so multiply by 60 you do, you'll get the closing stock of durable goods, which is 2.46. Add all this, you'll get the closing stock of finished goods, or total closing stock of finished goods, which will be 6.15 lakhs. This is your working capital estimate wala statement I'm putting up. One component we got it, which is closing stock of finished goods, 6,15,000. Bomol model ka cash also we have already got 24,495. Two components are done. Yes, people?
Yes, sir.
So closing stock and cash we have worked out. Next, similarly, we'll have to work out the next. Do we have any debtors? Yes. Sir, ideally this is a retail store. So should they have debtors? No. But since they sold the goods on a POS basis, that credit card customer is getting how many days credit? 9 days credit. Because they told in the question that 15% of the customers use debit card to make the payment, and it takes about 9 days for the funds to come to your bank account because of this credit card delay. Okay, so how much is the total sales? Total sales is 120 lakhs. So let's work out the debtors now. So that's what I've written over here. Usually FMCG company operates on what basis? Cash basis. Therefore, no debtors will arise. But here, since POS sales is given and 9 days is the clearing time, means the debtor will arise on account of POS sales. What is and moreover, in this working capital problems, we work out debtors on a sales basis or cost of sale basis? Cost of sale basis. Now you tell me, for calculating debtors, I need to take sales or I need to take COGS? COGS. In fact, I need COGS or COS? I don't need cost of goods sold. From COGS, if you add selling expense, you will get cost of sale. Yes, no? That we will take and find out debtors, correct? But anyway, how do you get COGS? So this is not your normal problem. Have they given you a material consumed? Have they given you a labor, conversion cost, all that drama? No. But directly, sales they have given, GP they have given. From sales, if you reduce GP, you will get COGS. One problem like this also we have done in our working capital estimate. Yes? And do we have any selling expense here? Yes. To install that POS system, no sir, we have to pay how much percentage fees? 2% fees. That becomes what? Your selling expense. Take your COGS, add selling expense, you will get cost of sales. Use that particular data to get the debtors. Can we work it out? COGS we already have. How much is that? 98 lakh 40,000. Done, sir. So this 98 lakh 40,000 is for what? 100% of sale. Does 100% of our customers buy using debit card, credit card system, or only 15%? 15%. I'm not saying. Question said that, right? Only 15% of the customers use debit and credit card. Rest of them buy on cash basis. If they pay cash, will debtor arise? No. Only relating to debit card and credit card, debtors will arise. And that constitute how much percentage of sales? 15%. So calculate. 98.4 is for 100%. For 15%, how much it will be? 98.4 ka 15% will be 14 lakh ka 76,000. Any doubt till here? Okay. This is the COGS relating to what, sir? Credit sales. Comfortable? We need COGS or we need cost of sale? Cost of sale. From COGS, how do you get cost of sale? Add the selling expense. And how much is the selling expense they told? Check the question. Installing a POS system comes with a fees of 2%. 2% of what? Total sales a lot. Total sales through POS. Total sales through POS. What is the total sales? 120 lakh. Are you paying a commission of 2% on 120 lakh? No. Total sales through POS. How much sales is happening through POS? Only 15%. 120 lakh is for 100%. For 15%, how much? If you do this, what are you going to get? You get POS sales. On POS sales, you have to pay how much commission? 2%. So calculate this and tell me, sir, how much you're getting. That's what I've written over here. 120 lakh of 15% into 2% gives you how much? 36,000 or 0.36 lakhs. By doing this, what did you get? Annual cost of sales. In fact, credit sales. How much is that? 15.12 lakhs. Any doubt till here? No? Okay. Now, from using cost of sale, can we find out debtors? Yes. This 15.12 is for 1 day or whole year? Whole year. How many is that? 360 days. Do we give whole year credit to our debtors or only 9 days is clearing time? 9 days. For 9 days, how much is a debtor? If you calculate that, you will get 0.378 lakh or 37,800. That's what we are putting into our statement. So closing stock of finished goods, we got it. Debtors, we got it. Cash, we got it. Yes, no, people? Adding all this, that's all is your current assets. Adding all this, you will get gross working capital. Next, one more component if you find out. Almost problem is over. That is your creditor. Okay, lengthy question, but nothing, no much of them. Just you'll have to figure out. Okay, you just have to calmly read the question. Institute, especially in examination, the pattern, they will give you a lot of data. But basically, psychologically, they want to put you on the back foot. Because we have that no matter what we say, the moment we see big question, we will always get scared. Ayyo, this question is almost 3 pages. Another 1 page question. The requirement. So 4 pages when someone reads, they'll be like, let's not do it now. Let's do it later on. But actually, this is nothing much. Every information they've only given over here. You just need to solve it quickly, and it's pretty straightforward only in my view. Yes, people? Okay so far? Alright, so till here we have found out. Next working note is to calculate the creditor. Now you tell me, sir, how do you get creditor? For creditor, we use COGS or goods purchased? Goods purchased. How do you get goods purchased? First of all, how do you calculate COGS? What is the equation to calculate COGS? Opening stock plus purchases minus closing stock. That gives you COGS. COGS you already have. How much is COGS? 98.4 lakhs. So COGS is given. It's a new store. Though an existing company, but this is a new project or a new store. Will new store have opening stock? 0. Purchases, that's what we have to find out. Closing stock we already got. How much is the closing stock? 6.15. So what about closing stock of raw material and WIP? It's an FMCG company. They're retailers. Retailer only deals with what? Finished goods. So closing stock of finished goods is how much? 6.15. Equate this. You will get purchases to be how much? 104.55. This is COGS for 1 day or whole year? That means this purchase what you got is for 1 day or whole year? Whole year. So this 10.45 is for how many days? 360 days. Do we get 360 days credit from our customers or from our creditors? No. Suppliers, meaning our creditors, give a credit period of how much? 30 days. So for 30 days, how much pro rate? You will get 871, 250. Correct now? That is your creditor balance which we have put up over here. You need a minute to review or okay? Comfortable everybody? Alright, next is online also. I hope everybody is able to remember. Okay, if you're not able to remember, no issues. Okay, I know that we are doing all this after most probably like 2 weeks break or something. I don't know, remember that. So some of you would have forgotten it. No issues. If you have forgotten, not a big deal. Once you revise the syllabus, after that you go through all this RTP, MTP questions. So it will like come back to you. Fine now? But it's okay. But it's one way, it's like a wake up call to us. If you're forgetting, it's time for us to kind of buckle up and do more revisions periodically. So that's okay. Keep an open mind. Okay, yes, awesome. That is great. Next, do we have anything else? Yeah, we read no somewhere. Salaries of this month, we pay this month or next month? And how much is salary every month? 4 lakh. That means how much is outstanding salary, sir? 1 month. Should we have to calculate? Directly we can take. No, outstanding wages or outstanding salary is how much? 4 lakh. Or if you want, you can calculate also. How much is the monthly salary? 4 lakh. 4 lakh into 12 if you do, what are you going to get? Annual salary, how much? 48 lakh. 48 lakh is for how many months? 12 months. Entire 12 month salary is outstanding or 1 month? Like that also you can prorate or directly write 4 lakh, your choice. So this also we did. Yes. So gross working capital, from that if you reduce current liability, what are you going to get? Net working capital. In this problem, the provision for contingency, safety margin and all, not there. I mean second requirement also done. They asked gross and they asked net. Check which option has that. 677 and 593. 677 and 593. Okay, so option number A is the right answer for the second MCQ question. Then they asked what, sir? Total funds needed to set up a store. So how much investment you should happen at year 0 is what they're asking. At year 0, what and all will happen? One, you need your normal investment and then you also need your working capital. Working capital means gross or net? Net. Oh, net number here, not positive. It is negative. Keep that. That means are we investing working capital or we have surplus? We have surplus. Is that okay with you, sir? Because we are getting good credit from creditors, no? See, like, we need only how much investment in current asset? 6 lakh. But our creditor only is, because creditor is a source of finance, he only is ready to sponsor how much? 871. So that means should have to invest in working capital or we have enough money? Enough money. So the total funding is how much, sir? Funding if you have to set up means, to set up the store they said first only we need how much money? 200 lakhs. Working capital is positive or negative? Negative. Positive means you add. Negative means deduct. So that means the amount required to set up a store is 194.0605 lakhs. All the numbers they have given in solution in lakhs. So presenting the solution. Check which has 194.0. First option is the right answer. Till here, pretty straightforward. Yes, no? Yes. According to me, yes, over. Alright, next they asked you overall cost of capital. And overall cost of capital is straightforward here or on slab basis? Slab basis. Because they told if funding requirement is 80 lakh means the debt is this much, equity is that much. If it goes beyond 80 lakh but up to 150 lakh, like that they've given it on slab basis. And moreover, this is not cost of debt. This 10% is interest rate. This 11.5% is not cost of debt. It is interest rate. That means I'll present a solution where they present it slightly differently, but I've presented my previous problem in the same format. So I've stuck to the same format. You can change just to revisit the things. You can change, present the answer any way you're comfortable. Alright, first we are trying to calculate KO. Sir, we have one source of finance here or two? Two. What are those? Debt and equity. And debt equity ka weightage can you change or it should not change? What should be the weightage? 2:1. Debt ka weightage is 2/3, that is 66.67%, and equity ka should be 1/3, as in 33.33 or 0.33. That should not be changed. So let's look at it. For the first 80 lakhs of funding, okay, what will be the debt ka weightage? 2/3 same. Equity ka weightage will be 0.33. How much for the first 80 lakh? What is our interest rate on debt? 10%. We need interest rate and we need cost of debt. How do you get that? Interest into 1 minus tax rate. How much is interest rate? 10%. What is the tax rate given to us in the question? 25%. So calculate that. If you do that, you will get 7.5%. Or directly take your calculator. 10 minus 25% you do. Automatically, what are you going to get? 7.5%. So cost of debt is 7.5%. Okay. Then what is cost of equity, sir? 12.5%. So equity ka weightage is this and cost is this. Debt ka weightage and cost is that much. So how do you get KO? Multiply these two, you will get this particular amount. Multiplying these two, you will get 4.125. You can take the numbers in decimals or you can directly take it in percentage. If you take this in percentage, answer also will be in percentage. If you take this in decimal, this also will be in decimal. Last answer you have to convert it in percentage. Your choice. So if your funding is only 80 lakh, means your KO will be how much? 9.15. But your funding is not 80 lakh. How much is the funding requirement for you? 194. In this 194, first 80 lakhs ka KO is 9.15. Then what does the slab ka question say? Beyond 80 lakh but up to 150 lakh. From 80 to 150 if you count, how much is that? 70 lakh. Meaning on the next 70 lakhs, how much debt ka weightage? Will the debt equity ka weightage change or same? Same. What about after tax cost of debt and equity? Is that same? No. Debt 11.5%. Is this KD or interest rate? So how do you get cost of debt? 11.5 into 1 minus tax rate. Or directly you take 11.5%, you reduce what, sir? Minus 25% you do. Okay, how much you going to get? 8.625%. Equity ka should we have to do any drama? No, because equity there is no tax benefit. So take the rate as it is, which is how much? 13.5. So this is the weight, this is the cost. So multiply, you will get this number. Similarly, multiplying these two, you will get equity ka number. Adding these two for the next 70 lakh, KO is how much, sir? 10.233%. Now able to remember that particular problem on a slab basis we did? Okay. Matter ended or furthermore? What does the question say? Above 150 lakh ka funding but up to 250. I mean, should we have to worry about the last or ignore? Because our funding stops at what, sir? 194 point something. That means the last slab that gets triggered for us is only third slab. Okay, beyond 150 lakh but up to 250 lakh. That means for how much is this slab, sir? It is 100 lakhs ka slab. But do we need 100 lakh funding? No. 150 lakh, we need only how much? 194 point, how much is that? 194.0605. That means how much money will be raised in this slab? Beyond 150 lakh up to 194.0605. How much is that? So on the balance 44.0605 lakhs. Okay, what is the cost of debt? Weight will be same. Cost of debt is 12% or I have to do interest, I have to reduce the tax. 12 minus 25% you do. How much is the cost of debt? 9%. Equity ka any drama or take it as it is? As it is. How much is that? 14%. Will the weightage change or no change? This is the weight, this is the cost. Multiply. These two you multiply, you will get this answer. And the KO will be 10.65%. Done. Now, is this answer or we have to take this and work out? We have to take this and work out. Okay, now the project cost. First 80 lakh will come from first slab. On first 80 lakh, what is the KO? 9.15%. On 80 lakh rupees funding, how much cost will incur? 9.15%. This is in percentage. Can you tell me the cost and amount? On 80 lakh funding, this is the cost will incur. So what is the cost, sir? This took a 80 lakh ka 9.15%. If you do, you will get 7,32,000. Correct? Similarly, on the next, how much funding? The next 70 lakhs of funding, what is the KO will incur? 10.233 or 23%. If you multiply 70 lakh ka 10.23%, how much you going to get? 7.161 lakhs. Now answer is given in lakhs. I am presenting the solution also in lakhs. On the balance how much we already wrote over here. Balance is how much? 44.065 lakh. What is the cost will incur? 10.65. So 44.0605 into 10.65% if you do, you will get 4,69,000. What is the total funding for the project? 194. What is the total cost incurred associated with the project? 19.171. This is the cost for this much funding. That means on an average, what is the overall cost you are incurring? For this much funding, we are incurring 19 point lakh. I just need the percentage. This is your loan amount. Okay, this is your interest amount. How do you get the interest rate? In fact, how do you calculate the interest, sir? You will take the loan amount and you will multiply by the interest rate. If you do this, what are you going to get? Interest amount. If I give you interest amount, if I give you loan amount, can't you find out rate? How do you get interest rate? Interest amount divided by loan amount. The interest amount here is 19.17 lakh divided by loan amount is this. It's not necessarily loan, it's the funding. Correct? If you do this, how much are you going to get the rate to be? 9.9%. What is that 9.9? The overall cost of capital associated with the entire project. That's what they asked in the question. What is KO? How much is a KO, sir? 9.9%. So C for Chennai is the right answer for fourth requirement. Any problem?
No, sir.
Last requirement they asked is how much subsidy will you get from the government? Did government tell us we'll get some subsidy? Yes, but there were some conditions for that. What is that condition? Somewhere we read that line, no? The revenue subsidy we'll get from government on how much, sir? 15% of GP. How much ever is our GP? 15% of GP we will get subsidy from government. But for that to happen, overall cost of capital should not exceed 10%. Did it exceed? No. We got 9.9. So that means is the condition satisfied? Yes. So will we get subsidy from government? Yes. How much? GP ka 15%. So what is our annual sales? They only told in the problem annual sales is 120 lakhs. Subsidy is calculated on sales or GP? So sales is 120 lakh. What percentage constitutes GP? 18% of sale. 120 ka 18% you calculate. How much is that? 21.6 lakh. Entire GP government will give a subsidy or percentage? How much percentage? 15%. So calculate the subsidy. Subsidy will be 21.6 ka 15%, which will be 3.24. So which option has 3.24? B for Bengaluru, the right answer for last option. That's what I've solved it over here only as one liner. Subsidy is this. Comfortable, Asaru? That's all is this case study all about. But good mixture of questions. They mixed C4, chapter number 4, chapter number 5, working capital management ka Baumol model and as well as estimation of working capital. That way they have combined nicely, but overall concept wise is pretty straightforward only. But once you need to quickly review. Okay. Alright. So this is the first question which we newly found. Hope this is okay with you. And don't worry, if you are not able to fully follow, that can happen, especially if you have given some break. Watch again all this video on the once you have finished the syllabus once, then again review it, then you should be able to get it in more detail. I hope we are not seeing stars. You there? That's okay, no? Little is okay, but full star means problem, pa. Full is no. Okay. Alright. Online also okay, na, pa? One by one they're coming, one by one they're leaving also, papa. Now, not now much. After class, we'll take up the extra fitting. Yeah. Now there are some exam related students. Yeah. And some extra whatever doubts you have, we'll take it after this session. So that we don't want to waste their time at this time. This point of time. Okay. Dividend decision. Actually, very repetitive question. Okay, but just quickly I've solved. So 2 minutes, I'll review that. So read the requirements, sir. You need to calculate the market price of the company. Market price of the company only we call it as P0. Yes. Now as you have to calculate this as per whose model? Gordon's model. Okay, Gordon's model, you know the formula? There are 3 formulas, no? If you remember. P0 is equal to D0 into 1 plus growth rate divided by cost of equity minus growth rate. Or if they have given directly D1 in the question, it will be D1 divided by K minus growth rate. Or you can also do E1 into 1 minus B divided by K minus BR. Depending on what, anyway, whatever you use, you will get the same answer. This is what we need to use over here. Check. Cost of capital, they've given it to be 12%. That cost of capital is nothing but your cost of equity. That is given to be how much? 12%. Expected EPS, not actual, expected EPS. Expected EPS means becomes your E1. Is how much, sir? At the end of the year is 20. Okay. Existing payout ratio is 25%. So currently, how much of earnings we are giving as dividend? 25%. That means how much are we retaining? 75%. That means we have this data to use this. Yeah. Or if you want, you can use this also. Because expected earnings ka, okay, 25% if you do, you'll get D0 or D1? D1. Because D0 is what? Actual dividend paid. Are you taking actual EPS or expected EPS? From expected EPS, if you multiply payout ratio, you will anyway get D1. Either you have a choice, either to use this formula or that formula, any which answer is same. Okay, the company is planning to increase the payout to 50. From 25, they want to make it 50. What will be the effect of this change on market price? Simple, sir. On to payout ratio, they are asking you to calculate price. And then comment whether the price increased or decreased. That's all they're asking us to calculate. Okay, reinvestment rate is 15%. That reinvestment rate is nothing but your R. R is given to be 15%. You have a choice. You can use this or you can go for that. Okay, I don't know. I think in solution they took D1, so I also put it up in D1. If you want, you can use that even formula also. So how do you get D1? Under existing case. Under existing case, what is the payout ratio, sir? Dividend payout ratio. Can I call it as DPR? DPR is equal to how much? 25% of what? EPS. In second case, dividend payout ratio is what? 50% of EPS. And both the cases, we just need to calculate the price. How much is earnings? 20. What is the dividend payout ratio? 25%. 20 ka 25% if you do, you will get 5. Don't write this as D naught. This is what? D1. Why? This 20 is not actual EPS. It is the expected EPS, they said. That means the number you're going to get is the D1. Cost of equity, they've only given in the question. How do you get B? B multiplied by R. Sir, if 25% of earnings, if you are distributing, means how much are you retaining? 75%. So B is 0.75. R, they've only given it to be 15%. So calculate, you'll get the growth rate to be 11.25%. Cost of equity is directly given. Substitute, you'll get the price. Is that okay with you? I'll not waste time solving fully. You got the idea? So in the current case, what is the price? 666.67. Now, is the dividend payout ratio same or they want to make it 50%? Expected earnings is still how much? 20. But payout ratio is how much, sir? Payout from 25%, they want to make it how much percentage? 50%. Expected earnings is 20 and they want to pay out 50% of earnings as dividend. So 20 ka 50% will give you 10. Now recalculate the growth rate because now is B still 75% or changed? If 50% of earning if you are distributing as dividend, other 50% you are retaining. So here B will become what? 0.5 or 50%. What is R? R is still how much? 15%. So growth rate will become 7.5. Now plug this numbers and you will get the price to be how much? 222.22. From 666 it became 222. So the price increased or decreased by how much? 444.45. So which option has 444.45? Decrease. B for Bengaluru is the right option for this. A very straightforward case. I've solved it to you just quickly there. Just to be on the safer side. Done now? Yes, sir. Okay. Alright. So third question is repetitive. Sir, if it is repetitive, we'll not waste time. Repetitive does not mean exact same question. Repetitive simply means concept is very much way the same. So if you have done our class notes, then you don't have to worry about this question because indirectly that also has a covered like that. Now this particular, I'll maybe tell off, fifth one is repetitive. Okay, sixth one is repetitive. Just to give you a little confidence, I'm just telling the repetitive one. Okay, seventh one is also repetitive. Eighth one is repetitive. Ninth one is also repetitive. That means 2 more questions if you do. Over. Classes are this session over. Okay, nah, fine. So, all right. This one also, my hands were tempting to write repetitive. I almost wrote repetitive also. Then I saw one adjustment. Debt service coverage ratio. Till now, I have never seen any question on debt service coverage ratio. We have discussed this concept. Okay, if you remember debt service coverage ratio, how much cash flow we have to pay the debt. Debt means what, sir? Only interest or also installment? Installment. How much money, how much cash flow we have to pay off the debt, people. Alright, that is given by the formula what? Cash flow before interest and tax divided by interest plus installments or principal also you can write. Okay, so how do you get cash flow before interest and tax? You simply have, in fact, if you flip through your notes, you should be able to get it. Take EBIT and to this, since you need cash flow, but earnings will include non-cash expenditure also. And I told you add back depreciation. So all you have to do is take EBIT and add back
earnings after tax and add back.
You can take that also, but no earnings anyway. Earnings tax rate and this question is not given on this in the question. I think macha. Okay, given over here. Okay, but no, I think I wrote there cash flow after tax. I don't think so. I think I wrote it as EBIT only. Yeah, have I just modified? Just check. I think I've written after EBIT only. Because we need, because see, cash flow after tax will not make sense. The reason is, see, we want to pay the debt, guys, no? Meaning, we want to know how much money is there before paying the debt, guys.
Sir, we have to add interest also, sir.
Which one?
EIT means?
No, yeah, if you take that equation, you need to add back interest. Or directly you can take EBIT and much better add back depreciation. In that case, if you can rework in other ways also. But I think this is a straightforward way to work it. Is that okay with you? Fine. So take EBIT. Since we need cash flow, we have to add back all the non-cash expenditure. Here non-cash expenditure will be your depreciation divided by interest plus installment. Other than this is a ditto question. Rest everything we have covered. I think some Temer Limited or some question I saw that we had a same adjustment. All this were ditto, except where one component is your debt service coverage ratio. And here in our maybe I don't know study material question, return on asset was on a post-tax basis. Return on assets was calculated on a post-tax basis. Here they have given it on a pre-tax basis. These are the only two new adjustments that came from this particular problem. Okay, but in which way we will solve this question or we will review this question quickly. Done? Now what you will do is, if possible, you will guide me how to do it because I have given you some pointers for them, if you remember. Now, current ratio is given to be 3.1. The moment I told you, the moment they give you current ratio, always look for one another related number, which is what? Either they will give you net working capital or they will give you asset quick ratio. Here quick ratio is not there, but net working capital is given. So if you plug or if you use the substitute, you can get what, sir? Current assets and current liability. That's the connection. Next they gave loan funds. Quickly we will read off. Loan funds to own funds. Loan funds to own funds. Loan funds means your debt, your long-term debt. Owned funds here refers to your proprietary funds. What are the components of your proprietary funds? Equity share capital, reserves and surplus and preference share capital put together. That becomes your owned funds. Done? Not equity, right? This is not net worth. Okay, net worth means what? Only equity share capital and reserves and surplus. Owned funds here refers to your proprietary funds. Proprietary fund will also include your PSC. So they have given connection for that. They have given GP ratio. They have given stock turnover ratio. They have given net working capital. I think we already got to know what is our working note number 1. What is our working note number 1? Current ratio and net working capital. We will use this. Return on total assets they have given. MPS they have given. Total asset turnover ratio they have given. Opening stock given. Perfect. Sir, they have given stock turnover ratio. If there is any reference to opening stock or average stock, we have to compulsorily use what in our stock turnover ratio? We have to use average stock, because how do you get stock turnover ratio? COGS divided by average stock. If there is no reference to average or opening stock, then we will use closing stock. Here they have given opening stock. So in our stock turnover ratio, we will use which component? Average stock. Then they have given fixed assets. Great. The moment I see fixed asset, I'll have a big smile on my face. Why? Sir, from these two components, what will I get? I'll get current assets and I will get current liability. I have my fixed asset. I already got my current asset. That means by adding these two, what am I going to get? Total assets. And here, what did they give you? Total asset turnover ratio. So using this, I can find out sales. Sales may they have given GP percentage. If I reduce GP percentage, I will get COGS. Using COGS, I will find stock turnover ratio. Everything dum. Okay, now that's the connection. Okay, people. Yes, they have given equity shares, 75,000 equity shares of 10 each. So equity share capital is 7.5 lakh. 25,000, 12% preference shares of 10 each. So preference share capital is 2.5 lakh. They have given depreciation. We need depreciation for our debt service coverage ratio. No? That they have given. Interest rate on debt is given to be 9%. This will help us to calculate the interest amount. Because again, for debt service coverage ratio, we need a interest, because the denominator is interest and installment. Interest rate is given means interest amount also you can find, and future installment also is given to be 2 lakh. So these two information are for debt service coverage ratio. Done. Now they're asking quick ratio. How do you get quick ratio? Quick assets divided by current liability. And how do you get quick assets? Current assets minus average stock minus closing stock divided by current liability. So again, if you know current asset, current liability and stock, easily you can find out quick ratio. Fixed asset turnover ratio, pretty straightforward. Debt service coverage ratio, we have formula. EPS they've asked. Earnings per share. EPS they've asked. Fine. Anyway, for debt service coverage ratio, how you'll get cash flow, no? To get cash flow, what do we use? EBIT. Now from EBIT, we need to arrive what, sir? EASH for EPS calculation. From EBIT, how do you get EASH? Deduct interest, deduct tax rate, deduct also preference dividend. That's what they've given over here. Then you will get EASH. Number of equity shares is given to be here only how much? 75,000. So you will get of what, sir? EPS. Then they've given price earning ratio. For PE ratio, we need EPS and MPS. Is MPS available? Yeah. That means only one requirement here is a change is the debt service coverage ratio wala problem. Done, people. So can we quickly review this question? Okay, first, current ratio. I have anyway solved it for your reference, so I will quickly review it. So one is, current ratio is how much in the problem? 3 is to 1. Meaning, can I say current ratio is current asset divided by current liability is 3. Therefore, current assets will be 3 times of current liability. Now substitute. Have they given net working capital? Yes. How much is that? 5 lakh. How do you get net working capital? Current assets minus current liability is 5 lakh. Instead of current assets, we will write what? 3 times current liability. Substitute, you will get current liability 2.5 lakh, current assets to be 7.5 lakh. Any problem? Review, that's all. No need to write down everything. Anyways, this video also will be available in your course. Later on, if you have any doubt, you can review. And every question, don't freak out that I want to have everything in my notebook. Not required. Especially RTPs, MTPs and all. If you review, that is good enough. Because in this problem, only thing new is what? Debt service coverage ratio. Rest everything we have done in other questions also. No? So we'll be able to any which way solve that. Okay, so if you just quickly review, identify the pattern of things. Like the way we reviewed here, no? Like that if you review yourself in your mind, okay, I should start with this. From here I will get this. Okay, from there what to do next. Like that if you are able to mentally paint a picture, that is good enough. Because solving everything, no, will take half an hour. If you have time, you can do it. But on the last day of examination or 2 days before the examination, don't waste your time solving full thing. Just review like this, that is good enough. Okay, coming back. So first we have done, that's what I've, for your reference, I've also written the order of information. Okay, I've renamed. So we have used 1. Next, I got current assets. They've already given fixed assets. Fixed asset plus current asset will give me what, sir? Total assets. How much will be my total assets? 22.5. If you just check the question, they have given total assets turnover ratio. How much is that? 2.5. That is the next information I need to use. How do you get total asset turnover ratio? Given by what formula? Any turnover ratio, the formula I told you, numerator is sales. First priority is sales. If sales missing, COGS. Denominator mein priority is average assets. If they don't give average information, we will use total assets. Here average assets can we find? No. So we have to, what is the formula here, sir? Sales are divided by TA. TA as in total assets. So total assets we already know, 22.5. Total asset turnover ratio is 2.5. By using this, we'll get sales to be how much? 56 lakh 25,000 by cross multiplying. Yes, sir. Now, you know GP percentage? Yes. How much is GP percentage? 25%. 25% of what? Sales. If GP is 25% of sales, then COGS will be 75% of sales. So I have COGS here. 75% of sales amount. Done. Once you know COGS, which turnover ratio uses COGS information? Inventory turnover ratio or stock turnover ratio? Is it given to you in the question? Yes. How much is inventory turnover ratio? 10. What is the formula for inventory turnover ratio? COGS divided by closing stock or average stock? Average stock. Why average stock? Because they gave a reference of what in the problem? Opening stock. So COGS divided by average stock you do. Average stock we don't know, but COGS we already know. So by plugging this particular number, we will get average stock to be 421,875. Done, Aji? And how do you get average stock, sir? Opening stock plus closing stock divided by 2. Average stock, you know, opening stock is given in the question. Check how much is that? 6,50,500. So using this, can't you find out closing stock? Yes, this 2 will be multiplied to the other side. 650 will be reduced. So you will get closing stock to be 193,250. You need a minute to observe, to review, or can we move forward? Till here all normal only? Yes. Then to find out debt service coverage ratio, we need what and also? We need cash flow before interest and tax. For that, we need EBIT and depreciation. Depreciation is already given. Next information is to just find EBIT. Now just check. They have given return on total assets. How much? 15%. So to find out return on total assets, we have 2 formulas. One is PAT. If you remember, PAT divided by total assets. Yes. PAT divided by total assets. That is one. Another one is EBIT into 1 minus tax rate divided by total assets. Alright. Yes, now I had told you that depending on what information you need, use that particular formula is what I had suggested you. Here we need PAT or here we need EBIT. That means which formula will we use? EBIT formula we will use. But this particular return on asset is on a post-tax basis or pre-tax basis? What is the formula for return on total assets? EBIT into 1 minus tax rate divided by total assets. But if you do 1 minus tax rate, you will get pre-tax or post-tax. But this information is given post-tax basis or pre-tax. So should I have to multiply 1 minus tax rate or cut off? Cut off. Because they have given the information like that. They have given the information on a pre-tax basis. So what formula will you write for return on total assets? EBIT divided by total assets. Don't do 1 minus tax rate. Because if you do 1 minus tax rate, what you will get? post-tax basis. But in the problem, clearly they told this return on total assets is on what basis? Is on a pre-tax. Hence 1 minus tax rate I have not done. Don't compare the book and say you did not do it. Clearly telling now only why we did not do it. Yes, sir. Total assets, do we know in the question? Yes, we already worked out. How much is total assets? 22.5. So substitute with this, you will get EBIT to be how much? 3,37,500. Done, Aji. We need EBIT or we need cash profit before interest and tax? Cash profit. And how do you get that? From EBIT, add back depreciation. Do you know depreciation given in the question? Yes. How much is that? 50,000. Take EBIT, add back depreciation, you will get cash profit before interest and tax. I'll give you a minute for this, just observe. Get yourself comfortable overall. Quick review, people. We're not going to go through whole day solving this. Yes, we have done enough number of questions. Now it's time to quickly to just review and get comfort around it. Okay, G. Now can we calculate debt service coverage ratio using this? Yeah, we got our numerator. What is the numerator for debt service coverage ratio? Cash profit before interest and tax. We got it. Divided by what? Interest and installment. Installment they only given. How much? 2 lakh. All we need is what? Interest. I mean, now you tell me what information I can use and get interest. You review and tell me. Perfect. They have given loan funds to owned funds. Something they have given. So if you are not sure how to use it, just present it an equation first. Then we'll figure it out. They have told what? Loan funds to own funds is 1:3. Okay, let's present that information. If you present that in equation, it will be loan funds divided by own funds. Is 1:3, or you can call it as 1/3. Therefore, can I say owned funds is 3 times of loan funds? Owned funds means what? Proprietary funds. Loan fund means your long-term debt. So basically, your owned funds is 3 times of your loaned funds as per the equation given in the question. Okay, G. All right. Now, what else I can proceed? In fact, I had given you some pointers also in our regular class notes. Whenever you're getting stuck, I had given you some equation. What are those equations? Here you have to use one of those equations. We did use this in one of the problems. Perfect. Sir, balance sheet equation. Balance sheet ka asset side total and equity liability ka total will always match. Balance sheet ka asset side total and equity liability ka total will always match. Tell me, sir, what and all will come on the liability side of balance sheet? You will get equity share capital, reserves and surplus, then you will get debt and preference share capital. Equity share capital plus reserves and surplus plus preference share capital, only we call it as what? Owned funds or proprietary funds. So can I call it like that? Plus what, sir? Loan funds. Loan funds becomes your long-term debt. Only long-term debt will only come, or current liability also will come. Current liability also will come. This is your equity and liability side of balance sheet. Any problem? Then on the asset side what and all will come? Fixed asset and current asset. So add those two. Done. Fine. Owned funds we already know. Instead of owned funds, what will we write? 3 times of loan funds or debt. Loan funds only we're calling it as debt. So instead of owned funds, substitute with 3 times of debt. Plus debt, loan funds only is your debt. Keep this as it is. Current liability, do you know? Yes. Current liability is how much, sir? 2.5 lakh. Substitute that. Then fixed assets and current assets, both you know. When you substitute this, you will get the debt value to be how much? 5 lakh rupees. Using this, you can also find out owned funds. But they ask balance sheet in the question. Then why bother? They do not ask it. If you want, you can calculate the owned funds ka breakup also. But since they have not asked it, I'm not bothering that. Not that if you do, it is wrong. Okay, sir. Now, if you know debt means, can't you calculate interest? Yeah, they only given interest rate in the question. How much is that? 9%. So, debt amount is 5 lakh. Interest rate is 9%. So, 5 nines will become how much? 45,000. That is your interest amount. Any problem? No. Now, one more working note we can put up and then we can calculate all the ratios together. They also asked EPS. For EPS, we need EASH. But what we have got is EASH or EBIT? EBIT. You can put up a normal format. How do you get a normal format to get EASH? From EBIT, reduce interest. You'll get earnings before tax. From that, reduce tax. You'll get earnings after tax. Reduce preference dividend. Then you'll get EASH. Or you can use indifference point ka formula. What is that indifference point ka EPS formula? From EBIT, if you reduce interest into 1 minus tax rate minus preference dividend. This is little time saving, so that's the reason I did this. If you don't like this approach, put it up in the normal format. One and the same. Correct, people? So EBIT we already know. How much is that? 3,37,500. Interest just now we got to know. How much? 45,000 into 1 minus tax rate. Tax rate is 25%. Minus preference dividend. Do we have preference shares? Yes. 25,000 preference shares of 10 each. So what is preference share capital, sir? 2,50,000. What percentage preference shares? 12%. So what will be your preference dividend? 2.5 lakh cut 12%. How much will be that? That's what I've written here. 2,50,000 cut 12% gives you preference dividend of 30,000. Correct? So solve, you'll get each to be 189,375. Again, I'll give you a minute. Just review. Ask me if you have any doubt. No? All fine? Yes. Now all the requirements one by one. First, what did they ask? Quick ratio. How do you get quick ratio? Current assets minus closing stock divided by current liability. Current assets you know, closing stock also you know, current liability also you know. Plug the numbers, you will get quick ratio. Next, fixed asset turnover ratio. How do you get fixed asset turnover ratio? Sales divided by fixed assets. No average information is available, hence we'll take the total fixed assets. Sales also we know, fixed asset also we know. Gets your turnover ratio straightforwardly. Debt service coverage ratio. How do you get debt service coverage ratio again? Cash flow before interest and tax divided by interest plus installment. Cash flow before interest and tax we worked out to be how much? 387,500 divided by interest. How much is interest? Here only we worked out. Interest is how much? 45,000. What is installment amount? 2 lakh. So 45,000 plus 2 lakh if you do, you will get debt service coverage ratio to be 1.58. So the whole intention of this question, if I have to sum up, means one is how to calculate debt service coverage ratio. That is one. Another one, they have given EBA, return on total assets, on what basis? Pre-tax basis. Okay, and also the loan funds and own funds ka connection they gave. These are probably some new fittings in this particular question. Yes. All right. Next, EPS. How do you get EPS, sir? Each divided by number of equity shares. Each is 189,375. Number of equity shares how much? 75,000. So do that. You will get each to be 2.525. Just 1 minute. I'll finish. Then they asked P multiple. How do you get P multiple? MPS divided by EPS. Is MPS given in the question? Yes. How much is that? 20. EPS just now we got it to be 2.525. So that gets you PE multiple of 7.9. So now it's just taking the numbers and dumping it into this particular format. Yes, sir.
Why are we assuming that installments is equal?
This is a future installment stuff. Interest plus future installments. You are saying this 2 lakh includes the interest component. Yeah, you can actually take that. That could, in fact, according to me, that is more valid assumption. But what ICA interpretation is, the way they calculate is, they take, in my opinion, actual formula should be cash flow divided by interest plus principal. Okay, and moreover here, all the installment will vary or it will be same. So if they've given installment, ideally you should take it in the denominator 2 lakh. In my view, that yes, I also concur with you there. But in the formula, if you clearly just check what they've told is interest plus future installments. Maybe there is some prepayment option, or I'm not sure why they've taken, but they take the installment component and interest component separately. In my view, it should be, in fact, if I discuss also, if I had done a discussion, I told you that it should be interest plus principal. But our ICA, mother body, sir, sometimes we cannot override. Bindas. But according to me, I also totally agree with you that because we are covering our debt service coverage ratio. His point is, sir, installment already includes interest. So now you added interest and you added an installment. That means it becomes a double one. No, ideally you should not do that. You should have directly taken what in the denominator? 2 lakh and ignored the interest. Totally agree with you. Marks will do this only. Okay, nah. Till this point of time, no point in questioning. Yes, but I do agree with you because the formula of ICA is also structured that way only. Maybe the reason is, I don't know, my gut feel is maybe there is some prepayment option in the debt and all which could change the installments or whatever. Even then, it doesn't provide a reasonable justification. But anyways, alright, I'll leave it at that. That's all. Fine now. So this question is a dum-dummer. You need a minute or you need me to review or zoom in on anything for any review or next question. Next question. So as I said, sixth one, no. Which one? Fifth one was a repetitive question. One moment, one pointer probably I'll tell you. Here, only this. I would like to bring it to your attention. It's a straightforward question. You need to calculate WACC using market value weights. There are 3 sources of finance. Cost of debt, cost of preference shares and cost of equity. Very straightforward everything. Except this cost of preference shares check. Rupees 100 preference shares. Rupees 100 preference shares means face value is 100. They are redeemable at a premium of 10%. That means they are redeemable means you will use approximation with formula. redeemable ka formula. What is that formula? How do you get KP? Preference dividend plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. RV is how much? 100 plus 10%, which will be 100, and anyway I've written here. RV is 110. Done? Okay. They are issued at a discount of 2%. Stop. Josh mein will take off. 100 minus 2% will do off. But let's read it fully. Flotation cost is 5% of the issue price. The current market price of the preference shares is 108. Josh mein don't calculate discount of 2% on 100. That's the reason I wrote this. Because I told you also, first priority, if you don't know whether it is new instrument or existing instrument, first priority always to IP. Issue price. If issue price is missing, next priority to market price. Market price also missing, then the last priority to face value. IP here is missing, not told. Okay, next priority you'll give it to what? Market price. Market price is 108. But are you issuing it at market price or 2% discount? Now calculate 2% discount on 108, not on 100. That's one mistake I thought someone could do, so I brought this into picture. So the issue price will be what? Market price minus 2% discount will be 105.84. That is what? Issue price. Do you want issue price or net proceeds? Net proceeds. How do you get net proceeds? From issue price, you have to reduce the flotation cost. Issue price is 105.84 and flotation cost is given to be 5%. So now reduce 5%, you'll get NP. That's all you need to. Rest everything is just plugging into the formula. Nothing much in this particular question. Okay, Saru? Okay. Now this question is also same repeato. No change there. Leverage also repeato. But I think this one I'll quickly discuss with you. Prepare income statement. Using leverage, we have done n number of problem with income statement. And this question also ditto. We have just probably name and value changed. The whole question is there in your material also in a way. So this aramse you will figure it out. I just wanted you to bring your attention to this. Margin of safety they've asked. Usually in the problem we did, they had given margin of safety. We calculated using margin of safety what? Operating leverage. Yes, because I told you, how do you get operating leverage? 1 divided by margin of safety. In this problem, they have asked MOS. Therefore, how do you get margin of safety? 1 divided by operating leverage. We'll have to use that. Because if you're preparing income statement means you have everything from sales to each. You have calculated everything. Right? So, aram se you can calculate OL, FL, CL or whatever need be. From if you do 1 divided by OL, you will get margin of safety. Any problem there?
No, sir.
Comfortable? 100%? Calculate, look at the third requirement. Calculate percentage change in EPS. They've given for 2 companies, but anyway, rinse and repeat. So one we will concentrate. Calculate the percentage change in EPS for both the companies. If percentage change in sales is 25%, stop there. Which leverage measures the relationship between sales, the topmost number sale, bottommost number EPS? Perfect. Combined leverage measures the relationship. Yes, sir. If you know income statement, can't you calculate combined leverage? Easily. So combined leverage you know. And how do you get combined leverage? In percentage, degree of combined leverage formula you tell me? Percentage change in EPS divided by percentage change in sales. Suppose combined leverage you calculated and you got it to be 5. I don't know, I'm just assuming. Then they have asked what is the percentage change in EPS? Do you know percentage change in sales? Yeah, that is how much? 25%. Therefore, percentage change in sales will be how much? 5 ka 25% will become 125%. Like that you need to calculate in one line. Okay, this I've assumed. 5 I have not seen. That's all is the funda of this question. Okay, we don't have exact question, but pretty much we have covered all this requirement. Yes, no?
Yes, sir.
Can I move to the next question, people?
Yes.
Online mein any question? No. Okay, dividend decision, exact same question. We have done it in class. I did the same question in marathon also. So this is a repetitive question. Okay, so same notes are there. So I'll not go into that. Investment decision also, concept we have covered, not the exact same question. In fact, you will tell me this concept. Based on that, I will get the confidence that I can review this question. You remember where we discussed in investment decision, where there is only one asset in the block. Chapter name is investment decision. Okay, we are buying an asset where there is only one asset in the block. That asset is being depreciated on a WDV basis. So what did we discuss on this concept? See, no issues. I'll review that once again. Sir, under income tax method, depreciation works on a block basis. Okay, for as far as the WDV method is concerned, you charge the depreciation on a block basis. As long as the block is there, depreciation also there. The moment the block ceases to exist, or comes to an end, on the last year we need to calculate STCG, short-term capital gain, or STCL, as in short-term capital loss. How do you calculate STCG or STCL? You compare WDV at the end of if suppose the project life is 5 years, I think here it is how many years? 5 only. Suppose the project life is 5 years, what will you do? You will calculate what, sir? You will calculate WDV at the end of year 5. Suppose that is 1 lakh rupees, assumption. Okay? I don't know, I've just taken some random numbers and reduce this or compare this with what? Salvage value. Here they are saying salvage value somewhere, what is that number? Scrap value is 140 lakhs. This is 140 lakhs. So maybe this number is too big. I'll make this maybe as 100 lakhs. As a number assumed. Okay. WDV is 100 lakh. Sale value is 140 lakhs. I don't know whether we got it here as a short-term capital gain or loss. I'll just see. I think it was a loss scenario. If it is a loss scenario, means what it should be, sir? WDV should be lower or higher? Higher. So maybe let's discuss this only. The relevant component, right? It's not going only, no? Let's make it as 190, right? 190. Okay, so you need 190, yeah? Or what are you saying? Okay, fine, it's too early, no? Okay. WDV at the end of 5th year is 190. So value of the asset is 190, but you sold it for 140. That means you made a profit or loss? Loss. How much is that? 50 lakh. That only we call it as what? Short-term capital loss. And that short-term capital loss, you have to pay tax or you will get the tax benefit. Get tax benefit. Tax benefit, no, you will have to apply normal tax rate or capital gain tax. Capital. If they don't give, take it as normal tax. But in this problem, check. Normal tax rate applicable to the company is 20%, but for capital gain is taxed at 15%. Now this particular 50 lakh, you will tax it at what rate? 20 or 15? 15%. And when will you get this benefit? Now or at the end of the project? That is what I've written. Tax benefit due to short-term capital gain or short-term capital loss in which year? Year 5. Is this concept okay with you? That's all they've brought in here. Very straightforward adjustment. They've given working capital and they've given depreciation. That's all. Manageable, no? Once quickly, maybe I'll read the question and I'll review this format with you, but not with numbers, just as a concept level. Because I think we have done 2 questions similarly. But anyways, no problem. A company is considering a proposal to take up a new project. Okay. It requires an investment of 850 lakh in plant and machinery. Okay. This is year 0 outflow. Yes. Along with this, there could be one more, which is working capital. 150 lakh is an investment in working capital. That means at year 0, the outflow is how much, sir? 850 lakh plus 150 lakh, which is 1000 lakhs. Great. And we know that is the only arrangement for working capital or one more. At year 0, you consider it as an outflow. At the end of the useful life of the project, we consider it as an inflow. That we also discussed. Project is expected to yield the following cash flow before tax and depreciation. One good thing. They have not given sales. They have only given cash flow before tax and depreciation. That means majority of things they have only worked out. Only 2 components have not yet deducted. What is that? Depreciation and tax. So 2 components if you consider, then you will get the cash flow. So and if you just check cash flow same every year or different? That means we'll put up 1 column or 5 columns. In fact, 6 columns. One for particulars and another for 5 years. Yes, now, so we have to start from sales or we'll start from profit. In fact, profit, what they gave is what? Cash flow only. So it's okay. You can write profit before tax and depreciation. This number is given to us in the problem. From this, you will do what, sir? Reduce depreciation. Okay, and we'll read off the whole question. The desired rate of return for the project is 14%, meaning your cost of capital is 14%. Asset must be depreciated at what rate? 20% on what basis? WDV basis. The scrap value may be taken as 140 lakh. Tax rate applicable to the company is 20%. On capital gain loss, you have to pay at 15%. You are required to calculate NPV of the project, also calculate IRR of the project and desirability project. Once if you calculate cash flow means anything you can calculate in a straightforward way. Present value factors, they only given at various rate. In fact, we know already what is the discount factor. How much is that? 14%. Use 14% this particular column to get what, sir? The discount factors. Yes, sir? So any dumb in the question? No. Yes, people, and in fact they told also this is the only asset in the entire block. Okay, fine. So that means whatever concept we discussed will also get triggered. So now look at this format. First we will take profit before tax and depreciation. Reduce depreciation. Depreciation should come from working note number 1 or 2. Maybe working note number 1 you can put it for year 0 outflow. Because there is investment also, there is working capital also. If you want, you can put working note number 1 for that. Working note number 2 you will calculate for depreciation. Copy all that depreciation. From profit before tax and depreciation, if you reduce depre, what are you going to get? Profit before tax. Then reduce tax at normal rate. What is the normal tax rate? 20%. Then you will get profit after tax. Then add back depreciation. Then your 4 adjustments, if I told you, you should not forget. One is the working capital, another one salvage value, another one opportunity cost. That opportunity cost could be an inflow or it could be an outflow, and additional cash flow item. Here additional cash flow is for short term capital loss ka tax benefit. Tax benefit means it's an outflow or inflow. Every year or 5th year? 5th year mein you should show tax benefit as an inflow. And how do you get this tax benefit? Compare WDV at the end of 5th year, which anyway working note number 1 or 2 will get you that. Compare that with the salvage value. Accordingly, you will get short term capital loss and calculate the tax at capital gain tax rate of 15%. Easy, people. The solution is anyway, if you want I can share this RTP file with you also if you don't have, or you can download it from, even I have also downloaded it from ICA source only, you can download and review. Manageable. Anything more you want me to discuss in this problem or all okay? Pakka no everybody? Okay, this is a new question. Easy but good framing. Okay, we'll read. This is one new question you could say. We will review this. I've solved this fully. So we will review this. But first we will read the question fully. This management of working capital wala question. Nirmo Limited wants to avail short-term loan from bank. However, bank grants a short-term loan by keeping collateral in the form of accounts receivable. In fact, we know, sir, using accounts receivable, you can take finance. One is you can give accounts receivable as a security to the banker and take a short-term working capital loan, or you can do factoring arrangement. Okay, here we are not doing factoring. Here we are going for a bank loan. But what you are giving as security? Receivables, as in debtors and bill receivables. A bank is analyzing receivables of Nirmo Limited to identify acceptable collateral for short-term loan. Then just because you gave debtors directly, they will not calculate. Bank will have their own policies. Because some debtor could be Goinda scenario also. So they will analyze on which debtor they can actually give the loan. So for that, they have given some requirements. Let's read. The current policy of the company is 3/10 net 40. What does this mean, sir? 3% discount the company will give it to debtors, provided debtor makes the payment within 10 days. Else he has to make the payment, he or she has to make the payment within 40 days. Okay. Bank will lend only to the extent of 90% of acceptable receivables. Suppose receivable value is 1 lakh. Receivables we are showing in our books is 1 lakh. Will bank give a loan of 1 lakh? No. 1 lakh they will take how much? 90%. Me telling or question? Question. This we call it as excuse me, drawing power. When you go for bank audit, you will hear this term DPVC, drawing power. Some percentage that depends on internal policy of a bank. It could be 90, 60, 50, 70, depending on how good or how creditworthiness or what creditworthiness the customer carries. The drawing power will vary. But here, how much is that drawing power, or what extent the bank is saying we will give? 90% of acceptable receivable. And interest rate is how much? 12%. Okay. Only if both the conditions mentioned below are fulfilled. So bank will take your debtor, multiply 90%, and that they will give you a loan of how much in this case? 90,000. This loan will carry how much interest rate? 12%. But for that to happen, two conditions should be satisfied, which they have called out below. Only if both are satisfied, they will give you. If it doesn't, what to do? They will call out, we'll see. First, we'll read the condition. Bank will keep a reserve of 5% for cash discount and returns. You know, if you have sold the goods, there may be some sales return also. For that, the bank is saying 5% I will reduce. Whatever debtors you have, from that I will reduce off 5%. So first, what will happen? They will calculate debtors. On that, they will multiply 90%? No, they will reduce how much? 5%. That means it will become 95,000. On this, they will multiply 9% and calculate the loan amount. That is the order they are trying to follow. Okay, Ji? Now, the conditions. What are those conditions? Customer are not currently overdue for more than how many days? 5 days to the net period. So, what is the net period we are given to debtors? 40 days. So one of the conditions bank has put forth is currently any customer should not have an outstanding of how much? 5 days more than the net period. How much is the net period? 40. That means the outstanding period should not be how much? 45 days. Because then what is the credit period? 40. So how much it should not be overdue by more than 5 days. That means the total overdue, no sir, for this customer currently should not be 45 days. If any customer is having more than 45 days overdue, I've sold the goods, let's say, what's your name, Macha?
George.
George. I've sold goods, let's say, to George, and it's been about, let's say, 50 days, and George has not yet paid me. Will George be considered for this 90% calculation by the bank? No. Because as per the bank, this number should not cross 45 days. Correct? That is the first requirement. Only one more. Average aging. One, they are considering the current aging. Sir, sometimes what will happen? No? Every debtor will not buy from us every month. Correct? No. Some will buy once in 2-3 months and all. And bank, no sir, will give all this loan on a regular basis. So they've kept one more condition saying average aging, meaning the payment period of the customer should not exceed 15 days past the net period. How much is the net period? 40 days. 15 days past that means what is the number we are looking for? 55 days. Current outstanding should not cross 45 days. Average outstanding should not cross 55 days. Okay, that's the two conditions they have put forth. Suppose if it crosses, what to do? Read the next para. If any of the above conditions are not fulfilled, bank will lend only 65%. If conditions are fulfilled means bank will lend how much up to debtors? 90% of debtor value they will give loan. If condition is not satisfied means the loan amount will only be 65% subject to a reserve of how much? 15%. Here reserve is only 5. Here the reserve is 15%. And interest rate here will be 15%. Interest rate there was how much? 12%. So that's how the bank has kept its norm. Fine. The corporate tax applicable is 25% on scrutiny of all the receivables following are acceptable receivables considered for lending. So they have given you debtors ka breakup. Company ka debtors ka breakup. Debtor number 1 to debtor number 10. Okay. This is the amount of debtors outstanding. Debtors amount. We have sold the goods and we have to recover from 10 debtors this much amount. Okay now. Check the third paragraph. They give outstanding in days. Average outstanding or outstanding? Outstanding in days. That means which condition should get triggered here? First condition. What is first condition ka funda? Customers are not currently overdue for more than 5 days to the net period. That means outstanding should not cross how much? 45 days. That means you will have to analyze here, identify which debtor has crossed 45. Because if it has crossed 45, will the bank give 90% or only 65%? 65%. Which debtor crossed 45? I've circled it over here. One is your debtor number 7 and another one is your debtor number 3. Rest of them looks to be satisfied. Only these two guys, conditions have failed. Conditions have failed means 90% loan value, 65%. 60 or 65? What did they say? 65. Correct now. So that means these two debtors we have to consider for 65% calculation. This is condition number 1. Only one condition or one more? Second condition was what? Average aging. Have they given average aging? Yes. Here average aging is given. What is the condition for average aging? It should not exceed 15 days to the net period. What is net period? 40. 40 plus 15 you do, how much is that? 55 days. So average aging should not cross 55. That means we will scan all this number and look to find out what? Those debtors exceeding 55. Which has cost 55? Debtor number 4. Condition number 2 has failed. Here debtor number 10. Condition number 2 again has failed. That means this debtor also will be eligible for how much? 65% of the loan funding. Rest of the debtor. That means totally how many debtors have failed the conditions? 4. So in 10 debtors, 4 of them have failed the condition means these 4 ka calculation will be done on what basis? 65%. Balance 6 will be calculations on 90%. Very simple question, but good framing. That's all. New way, entirely new way they have found the question. But understood? Now you need to calculate the amount lent by the bank. Very straightforward, sir. Now you know the amount, how much is the amount of debtors. For few debtors, 90% calculation with 5% or 15% reserve. That's all is the amount lent by bank. And then they're also asking effective interest cost, not in amount, but in percentage. Basically, they're asking you cost of debt. Effective interest rate is nothing but your cost of debt. Because bank loan is also debt, no sir. Or don't say interest rate is 12%. What is the interest rate here? On one loan it is 12, another loan is 15%. Okay, so 12% and 15% is cost of debt, sir. No, we have learnt on interest you always get the tax benefit. Though you are paying interest of 12% on that, you will get the tax benefit. That means you have to use that formula. How do you get cost of debt? Interest into 1 minus tax rate divided by net proceeds. Take the interest amount. As I told you, you can take interest for one loan or one debenture and net proceeds for one debenture and calculate. Or you can take total interest and total net proceeds and calculate. Answer will be same. That is the two requirements. Can we quickly review this question? Okay, first is, anyway, we will review the questions only. You no need to give goli gili and all, okay? Directly you start with this, okay? Requirement only. Lent by bank. Two types of lending here. You need to have three columns. What are those? One is particulars. Second column ka heading is what? Some debtors are eligible for 90% lending. Some are eligible for 65%. Who are eligible for 65%? Debtor number 3, 4, 7 and 10. So 3, 4, 7, 10. What is, that's what they've written here. 3, 4, 7 and 10. What is 3 and 4 ka value? 120 and 72. What is 7 and 10 ka value here? 7 ka value is 19,000. 10 ka value is 37,000. 19 and 37. Correct, people? Adding all this, you will get 2,48,000. These are 4 debtors who comes in which category? 65% category. Rest 6 of them will come in which category? 90%. All that amount you copy from the question. That is okay with you? If you sum it up, you will get 454. Now first we will do for 90% lending. What is the total value of debtors who are eligible for 90% lending? 454. Will bank give 454 or there are two deductions? One, there is a reserve of 5%. Correct? And on that, then you have to multiply 90%. Correct? First, reduce reserve. How much is the reserve for 90% category? They told over here only, For first category, the reserve is 5%. For second category, the reserve is 15%. So reduce 5% from this. 4,54,000 minus 5% you do. You will get 431,300. You can calculate separately or directly you can calculate. Now, will the bank give us 431,300 worth of loan or this into 90%? This is the eligible amount. This ka 90% if you do, you will get the loan amount to be 388,170. Tell me any problem or confusion in this calculations. All okay? Paka. Same calculation, do it for 65%. Loan amount you know, or matlab debtors amount you know. First you have to reduce what? Reserve. For this category, how much is reserve? 15%. So calculate 2,48,000 ka 15%. 37,200. Reduce that, you will get eligible amount of debtors to be how much? 2,10,800. Bank will give full amount of debtors or only 65%? So 2,10,800 ka 65% you do, you will get 137,020. What are these both? This is the amount of loan given by the bank. So what is the total loan? They have put the next solution in the next page. I have written here only for your reference. Add these two, you will get the total loan amount how much? 5,25,190. Correct? That's the first requirement of the question. Second requirement, they asked you effective interest cost. For that we need interest amount divided by net proceeds. Net proceeds here is nothing but your loan amount. Interest first let's calculate. We have one rate of interest or multiple. On this 388,170, what is the interest rate bank is charging? 12%. So calculate this is the amount. On this loan 137,020, how much is the interest bank is charging? 15%. They've clearly given all that data. That means this is the interest on the second loan in a way you could say. What is the total loan you are paying? Total interest you are paying to the banker relating to this loan? 67,133. You got the interest, you have net proceeds. How do you get the cost of debt? Interest into 1 minus tax rate divided by net proceeds. Since I don't know because see debenture will have a face value. One instrument ka value. We can calculate on unit basis. But loan and all will have unit value. Loan is always measured on what basis? Total. Hence always apply what formula? Total formula. What is the total interest? 67,133 into 1 minus tax rate. Do you know tax rate? Somewhere we read, no? Tax rate is 25%. So into 1 minus tax rate you do divided by net proceeds. Net proceeds is here is what, sir? Nothing but your total loan amount. How much is the total loan amount we got it? 5,25,190. Do it, you will get 9.5%. So that's all this is question. Review this question once. Very easy. Okay, but a good framing according to me. Again, all this may come for like 6 to 7 marks. Especially when they give you new framing, no? Institute knows that majority of them will not even try. Because see, now you have seen the solution, so you know that it is pretty straightforward. But if you see this question straight away in examination, That mind will not run that quickly or fastly. So hence all these questions, usually they give it for like 7 marks, 8 marks, They'll be quite liberal there, okay? So those of them who solve, who reads it, bumper for them. Those of them who don't even read, skip, they'll be little disappointed, okay? So it's okay, no problem. But whenever you read a new question, don't waste too much time in examination. Do it always at the end, okay? Because you don't know, because this adjustment seems pretty straightforward. But they may also bring in, like, let's say, factoring arrangement also in this. See, framing can be done any which way, no? Suppose they say company has another option to do factoring arrangement. Like that also they can bring in. So like you can do multiple framings there, yeah? But anyways, first you do all things that you know clearly. Reserve whenever you have like 15-20 minutes, you feel when you have more time, means come back to these sort of questions and review. I'm telling the new questions, if it comes entirely new in your examination, that also, as I told you, 1 or 2 questions you should expect newly in every paper. It doesn't matter how many RTPs, how many MTPs, how much study material question you have done, still 2 or 3 questions will always be new. Go with that mentality, okay? If too many questions comes new, then the remaining questions will be copy paste from study material. So focus more towards that and try to score as much from that. From here onwards, how much ever you score, bonus. Okay, people. So that's all. The rest is just they've given some theory criteria that you can go through for yourself. Okay, this was a quick review on January 2025 RTP of financial management. Thank you.